Hey all, this is Shubhanka here from Quantsapp. Welcome back to another episode. So now in this video, we are going to understand about when we are going to buy a call option, when we are going to sell a call option, and also about the put option when we are going to buy and sell the put options. And also we'll try to understand the concept of buying versus selling of options and what are the pros and cons of it. So first, talking about when we are going to buy a call option. So when we are going to buy a call option only when we expect the underlying price to go up, the underlying to be bullish. And when we are going to sell a call option is when we expect the underlying at least to be flat or to be bearish. So the price of underlying at least should go down or else it should remain flat, but the underlying price shouldn't go up if we have sold a call option, elsewhere it will give us a loss. Now talking about put option, so when we will sell a put option is when we expect the underlying to be flat or slightly bullish, and else when we are going to buy a put option is when we expect the underlying to go drastically downwards, when we expect the underlying to be bearish. So that was pretty simple again. Now talking about the buying versus selling of options. So let's try to understand it one by one. So buying of options involves limited risk, whereas selling of options involves unlimited risk. So let's try to do it. So now let's try to take a practical example of it and understand the limited risk and unlimited risk scenario in option buying and selling. So I'm in Architect tool now. You can go ahead and select your desired F&O instrument. I have selected Nifty. Expiry is 15th of July. So let's say 15,900 call option. The price right now is 12.05 of that option and we are buying it. And I will click on add. So automatically there would be a payoff chart would be plotted out here on the graph below, wherein the white line on the graph is showing us today's end of the day PNL, whereas the orange line on the graph is showing us the PNL as on the expiry date. So expiry is 1 day from here, so it is showing us the tomorrow's end of the day PNL chart. Now in this scenario, if we have a look upon, my maximum loss is limited to the option premium which we pay. So if Nifty goes anywhere, let's say even if Nifty goes up till 15,048, my maximum loss is going to be 904 rupees, which is, by the way, the amount of option premium we paid to buy this option. Wherein on the upside, as Nifty goes in the upward direction, I'll be making a profit. So now let's try to simulate the effect of it and understand the terminology of unlimited risk versus unlimited risk scenario. Now let's say I'm in option architect tool now. I have selected my symbol as Infosys. You can go ahead and select any of the F&Os listed. Then we need to select the strike price. So let's say 1580 call or put, we have bought or sold it. Let's say we have bought the option of 1580 call of Infosys and the premium right now is 35.5 and I'll click on add button. So the payoff chart is created on our screen, wherein the white dotted line is showing us today's end of the day PNL, whereas the orange line on the graph is showing us the PNL as on the expiry date. So now if Infosys goes anywhere on the bottom side, so we have bought a call, right? So we are expecting the underlying to go up. So now if Infosys goes against our view, wherein Infosys goes bearish from here, you see even up till Infosys goes up till 1480 level, still we are going to make the maximum loss of 18,579 in today's date. Similarly, if we hold this option up till expiry and Infosys goes up till 1480, my maximum loss is going to be 21,300. So as we can see, even on the expiry date, our maximum loss, Infosys going anywhere against our view as well, our maximum loss is 21,300, which is, by the way, the amount of option premium which we paid to buy this particular option. So in this scenario, our risk is capped at a point. Our risk can't exceed beyond the option premium which we paid, which was 21,300 in this scenario. 35.55 into the lot size of Infosys, which is 600. So that was the limited risk scenario. Now let's try to understand the other example on the selling side, which is an unlimited risk scenario. Now let's say we are expecting again Infosys to be bullish. So what we did is we sold a put option of 1580 put, wherein in this scenario, if the underlying goes in my favor, I am going to make a profit. But if underlying goes against my view, which is if underlying goes bearish, I will start to make a loss. Now in this scenario, if Infosys keeps on going on the downside, my loss will keep on increasing. So if in the same scenario, if Infosys reaches 1480 level on the expiry date, we are going to make a loss of 40,450 rupees. Similarly, if let's say there is no bounce to Infosys going at a particular point, right? Infosys can keep on going in the downwards direction. There is no limit to it. So let's say if Infosys goes up till 1380, you see my loss has increased to 1 lakh rupees approximately on the expiry date. So in selling, because we have sold this in advance, so when selling, our loss might keep on increasing. So our losses aren't capped at a point, it will keep on increasing. Our losses are unlimited in case of option selling. So the second point is, option buying requires limited capital, whereas option selling requires higher margin. Okay. Now, when we are buying an option, we are paying a premium in advance, right? So in this scenario, 35.55, which was the call's price into the lot size, becomes our investment while buying an option. Wherein in case of selling an option, we required a much more higher margin to sell a particular option. Third point is, buying involves unlimited gains and selling involves limited gains. So now let's try to understand this graph, wherein let's say if Infosys keeps on going in the upwards direction, there is no barrier कि Infosys will go only at till this level. It will keep on increasing, right? So that is the reason if we have bought that option, our profit can be unlimited. Whereas in the other scenario, when we had sold a put option, our profits are capped after a point. We can't make more than the amount of option premium which we paid. So over here, 32.2 rupees is my maximum profit if I have sold 1580 put option of 29 July expiry, because that is the amount of premium which we receive. Our profit can't exceed the amount of premium which we receive if we have sold that option. So in case of option buying, so coming to the fourth point, which is premium in lost. So coming to the fourth point, in case of option buying, premium is lost due to time value of money. Okay, and in case of selling, time value goes in our favor. Now, options, they are an wasting asset. Each and every passing day, our options premium will keep on decaying due to the time value, the theta decay which has been caused. So, if we have bought that option, our option will continuously keep on reducing in its premium. So now, options are an wasting asset. They are not an investment we make. Each and every passing day, our option premium will get reduced due to the theta decay, due to the time value of money. Now, let's take an example, 1580 call, trading at 35.5. If we hold this up till 5 days from here, our premium will automatically get reduced by 6.23 rupees and the premium would be quoting at 29.27, which indicates that if we have bought that option, we can't hold it for a longer time, because each and every passing day, our option premium will keep on getting reduced. So that is going to eventually turn into a loss. And option buying, we can't buy an option and hold it forever because it is not an investment we make. Whereas in case of option selling, the theta decay which is getting reduced of options each and every passing day is going to benefit us. So let's take an example. So now, talking about selling of options, so the theta decay which has been lost from each and every on each and every day from each and every option premium, that is going to benefit us if we have sold that option in advance, right? Because if we have sold it at a higher price, ultimately it keeps on decaying and our premium will get reduced, right? So now let's say if we have sold this 1580 put option, 32.2 is the price right now. If we hold this option similarly for 5 days, you see it is, I would say the premium has reduced by 6.17 rupees again. So which indicates that is going to be our profit if we have sold that option, because we have sold it at a higher price and then in the market it would be available at a lower price, and when we square off our position, we are going to get this 6.17 rupees as our profit. So option buying works only when direction is correct. So if we have bought an option, only if a directional move comes in, only then we are going to make a profit. But in case of option selling, even if the underlying stays stable, we are going to earn the profit due to the theta decay, the time value of money, which is getting decayed day by day. So selling of option can be directional as well as non-directional as well. It will give us a profit even in a flat market, oscillating market. So to summing it up very quickly, option buying involves limited risk, limited capital, unlimited gains, and in option buying, the time value is enemy of the option buyers, and option buying only works when the direction is perfectly correct. Further, option selling works when the directional is either directional or even in the flat market, in the oscillating market. Time value goes in favor of option seller. Option selling has limited gains involved in it. Selling requires higher margin, and selling also has an unlimited risk along with them. So I would say that pretty much was it from this video. So if you have liked this video, do stay tuned with us. So do hit the subscribe button, do hit the bell icon, so whenever we post something, you will receive a notification. Thank you.